listen-only mode.
Good afternoon, everybody. Stan and Jack here for theartofchart.net, and we are doing a webinar today on trading futures and using what I call non-traditional Elliott wave. And we're gonna give examples today. We're going to talk about basically this agenda. Let me share the agenda with you. What's different with non-traditional? How is it different from the normal Elliott wave? And it's a little different because I trade futures a lot, and I find that the 3-wave method instead of the 5-wave method, that's what I call non-traditional, by the way, it fits better. I'm going to show you some stock examples, and you're going to see the 5-wave structure, okay? But then I'm going to show you natural gas, and you're going to see a 3-wave structure. And then I'm going to show you coffee, and guess what? You're going to see a 3-wave structure. So the non-traditional for me fits very, very well with futures. We'll go over counts and structures. And by the way, folks, I hope everybody realizes that you're not going to learn this in a 1-hour webinar. I'm going to give you the overview. I'm going to show you some basics, okay? And I'm going to point you at some other things you can read. And by the way, any questions you have a questions tab in the GoToWebinar panel, and just add your questions there. We will deal with them as we go along, okay? So that's basically what we're going to cover. Let me do this. Let me do a quick run through the site. For those of you who are new, I just want to show you kind of what we do here. We have first of all, at the beginning of every month, we do a chart chat webinar. So that's free to the public. That's a way for us to show you guys how we do what we do. See all these commodities up here? This is what we cover in every chart chat, and this is what we cover on the site. So you can see it's a mixture of indexes, commodities. We have stocks as well, and we have a 14-day free trial for the futures part of the site, but also for something we call the Big Five. The Big Five: Amazon, Tesla, Netflix, Facebook, and Apple. This is also a 14-day free trial, so we encourage you guys to use it to get a taste for what we do. The other thing I wanted to show you is our blog, and I think the blog is important. First of all, every month we have a free webinar posting, and if you go to this free webinar posting, you will see, and I'll take you there real quick, you're going to see this webinar, okay? And now the recording for this webinar will be on this page, usually about an hour afterwards, right? So, you can see the previous webinars we've done, and the chart chat webinar that we do at the beginning of every month is on this webpage. Right here is where the webinar is going to be posted when we're done. So just so you know that. And the other thing on the site that I think is important is the weekly call. So what we do here is out of, I think we have, how many instruments, Jack? Over 30 that we track. And what I try to do is,
I think it was 35 to 40 altogether.
Well, if we had the stocks, it's more than 30. We're tracking 30 futures. I know that, but we have more than 30. But what I do is I call through them and I try to find good setups. So here on this page, every week, once a week, the weekly call, you'll see setups like the one on live cattle. We're up $11 on live cattle since the initial call. This is swing trading, not day trading, okay? I'm not going to give you a day trade here. So we called a big turn here in cattle, 18-month low, and I think we're going to see a trend change, time-based analysis as well. And then gold, we made a call on gold. We estimated 60 handles. We captured 50. We're out of the gold trade at this point, looking for the next setup. And coffee was showing, and I'll show you coffee today. Coffee was showing a great counter trend move from up here, and look where we are. We've hit that one pretty darn well. So the cream of the crop is typically here on this page. I posted here so people can see what we're up to. That's kind of the site for those of you who are new to theartofchart.net. And so with that said, Jack, anything you want to add? Anything I forgot?
Nope. That's okay. Let's go.
All right. Let's take a look at Elliott wave. First of all, Mr. Elliott, he noticed a pattern. And I think you guys may be familiar with the story, which is stocks tend to have a 5-wave sequence. And they tend to have a emotional, every wave sequence has an emotion attached to it. Okay, greed, wave 3, okay, indecision, a triangle. So you see different types of emotions in the stock market, and his whole thing was that stocks move with a crowd mentality, and he put a notion together in terms of a pattern that he saw. All right. Well, we've gotten so advanced with this. We have so many different patterns and so many different ways of using this that, frankly, what's happened is, and I'm trying to get to the picture here. Okay, here we go. we've gotten so advanced with this that frankly it is a, and this is me talking, this, in my opinion, there is no rule book for Elliott wave. It's extremely subjective. Okay, so you go from one person to another, and you're going to find different ways of using it. And the reason you're going to do that is, I'm going to say this, every instrument is different. If I look at Apple and then I look at coffee, I'm sorry, they move different. Okay, the sequences are different. The wave structure is different. And so you got to apply what you know to it. And the other thing I want to say is Elliott wave by itself is absolutely, in my opinion, worthless. You want to lose money? Just do wave counts. I promise you, you'll lose money. You have to integrate this with Fibonacci's, with pivots, with time-based analysis. I integrate this with a lot of other technical analysis tools, and I like
RSI.
it. Say again, Jack?
RSI.
Oh yeah, RSI, absolutely. So, you know, there's a lot of other things to actually, first of all, you got to use RSI to even identify what wave you're in to begin with, okay? And so I'll show you some of that, the basics again. We don't have, like, I could do days on this, okay, but I'm going to do just like 30, 40 minutes to give you the overview. The reason this is important, like for example, the coffee short I just showed you a moment ago, okay, and the chart was here. Let me just go back to it quickly, and I'll just make the point to make the point. I use counts because I can predict, you see that big W there? We were at the end of a 5-wave sequence. The big W hit on coffee right at a high window. That's time-based analysis as well. And I could tell right there we were in for a big retrace. I don't think we're done yet. Okay, I think we have more downside coming. So, you know, when you count and you have a sense of structure, you can predict the big moves, okay, the big counter trend moves like this, okay, and so that's why I use this. I find it useful from that perspective to understand. So where am I? Am I at the beginning of a third wave? I want to capture third waves. Like you don't understand. I hunt for those on purpose because that's where you make your money. Do you think you make your money at the turn on a first wave? You don't. Do you make your money on a fifth wave? You don't. And typically you don't try to trade them. Okay, on a fifth wave, I'm looking to go the opposite way. Okay, so you know, if you can get familiar with it, it's helpful because you can cherry pick, you know, where you want to put your money, where you want to put your money at risk. That's kind of why I use it. Now, the purpose of this diagram is very simple. There's this thing called traditional Elliott wave, okay, in black, and there is what I call non-traditional Elliott wave in blue. And the reason I use the non-traditional, and I'll make it very simple, it's easy. It's far easier and it's less complex, okay? And I'm going to introduce it to you on a real chart here in a few minutes. But basically the non-traditional, if I'm looking at a 5-wave structure, you have nested 1-2s. You have a 1-2, then you have another 1-2, then you have another 1-2, 3, 4, 5. That finishes the third wave. Then you have a fourth wave, and then you have another fifth wave, which finishes the third wave from down here, right? Then you have another fourth wave, and then unfortunately you have this thing called an early terminated fifth wave, okay? Now, I don't believe in early terminated fifths, and I used to do this all the time, okay? I've been trading since 1999, and I used to do this, you know, in my early days in stocks, okay, when I traded stocks. And what I'll tell you about this is when I did it even back then, it was like, this doesn't feel right. How can we have something like this that outlines structure and have this thing called an early termination? How does that make any sense to anybody? Okay. Now, this non-traditional thing, there is no such thing as an early termination because as you can see here, it's a 3-wave structure. In blue, the A, B for a 1. Okay, here's your 2, and then an A, B, C for a 3, and there's your 4, and then an A, B, C for a 5. All it is it's a reorganization. It's a reorganization of how to put together counts. That's all it is. And it's dirt simple. The guy who wrote the book on it, his name is Ian Copsey. Lots of people use this, okay? I'm not the only one that uses this. This is not novel, okay? This is not my invention. He invented it. He wrote the book. So he has 2 books. You want to read more about it, read it. But they're not uncomplicated. I try to use what's simple because I think traders make life difficult for themselves by using too many indicators, too many things, right? So I try to keep life simple so I can look at 30 charts an evening and try to make sense of the markets, okay? So that's basically the overview of non-traditional, okay, in terms of how it's different from traditional. And guys, I like it. It helps me identify the third waves clearly. These early terminated fifths, I don't have to worry about them anymore. So that's kind of how I do it. Okay, so with that said, Jack, I'm going to show a couple of charts, and I think Jack's going to cover some triangles. I'm going to cover flats and also what the 5-wave sequence looks like. Yeah, Jack.
By the way, Stan, did you say the ZB one this morning isn't an Elliott wave one?
I would have to take a look at that right now, Jack. But okay. I think I would just show a triangle as a continuation pattern, which is fairly traditional, and ZB one I think qualifies. Whether it's a traditional, whether it's a classical triangle, there are classical and Elliott triangles. They're different. Okay. Now I'm showing Apple here for a reason, because I just want to show you a channel formation. Elliott has a lot to do with patterns. Okay, you have to recognize the pattern that you're in. So this is a very, very traditional channel formation, and those of you who know Elliott know that you typically connect W, which is here, with Y, which is here, and that typically, it doesn't always come close to the high, but it usually comes pretty close to the high. Usually you have a W, Y, and Z connection, or pretty damn close to it. And you can copy this line, and of course you have a channel, and then you can count inside of the channel to understand where you are in the structure. Now, very basically, there are 3-wave moves inside of this structure. Okay, now you have to be able to understand structure. Like, for example, this spike right here, I throw it out. Okay, and this is basically a 3-wave move. And the way I'm going to show you 3-wave moves is by using Fibonacci's. Okay, so first of all, there's an AB here. So from the W, I measure A, B, and look where it goes, right to the 2.618. Why? Because this is an A, B, and a 5-wave structure for a flat. Okay, so with Elliott, you have to learn about structure. This is a retracement pattern. Here it is, 3 down for the A, 3 up for the B, and a 5-wave structure down. That's called a flat. Okay. Right there it is. Now, flats typically go to one of 2 targets, the 1.618 or the 2.618, one or the other. So if you're in this and you're in a short and you recognize it, here's the W. Okay, so we finished W. And how do I know that we finished W? Look at RSI. We have a divergence here. Okay, so I know that we're done with W because there's the divergence, because there's your 3rd wave right there, the high in RSI. Okay, and then we have a divergence for the 5th wave. Okay, now not all structures have divergence, but 5-wave moves have divergence always. Okay, and so in some commodities now, and you got to be careful with this, some commodities move in 3 waves and they don't have divergence. So remember, divergence isn't always going to happen at a turn, it happens in 5-wave structures. So here, for example, is a 5-wave structure, A, B, 1, 2, 3, 4, 5. Let me get rid of the fibs here. And remember, 2 targets, 1.618 or 2.618. It can be either one. And commodities, not necessarily stocks, tend to hit extension targets, more so than stocks. But I'm showing you the stock example because I want you to notice what's here in the middle. This is a 5-wave move. Typically, you don't find these in commodities, okay? And this is a 5-wave move, okay? You typically don't find that in commodities. So this is a fairly traditional structure. You have 5 waves up, you got a flat. 1, 2, 3, 4, 5 waves up, 3 waves back, perfectly, we called this, by the way, for just a simple 3-wave move to 100% fib, right? And here is another 5-wave move that finishes the move, by the way, right in a high window, very close to a trend line. And then what happens when you hit the larger degree W? You break the trend line of the channel. You can predict that like clockwork. Okay, if you get your counts right, you can predict, like I showed you in coffee, and that's why I use Elliott. You can predict these moves in terms of what's going to happen, okay, with some degree of accuracy. And by the way, nothing in trading works 100% of the time, but I hope that what I'm doing works 70% of the time in terms of its ability to predict, you know, tops and turns and support and resistance and so on and so forth. So, and this structure here, and by the way, you have to learn to read structure. This is an expanding structure. Do you guys see it? So here we have, and this is what you learn how to do when you do this every day. Okay, here we have 940 ticks, okay, for a short wave W, okay. What happens? It expands. Oops, sorry, wrong tool. Let's get this out. It expands. This is an expanding diagonal. okay? It expands 1463, and then it expands more, okay, to 1475, okay? So it's an expanding structure, okay? So what do you expect to see at the top of an expanding structure? Well, there's a little divergence there, but a very, very high in RSI, right? A wave Y. And by the way, Y or the third wave is always your highest RSI reading, right? Then what do you expect to see for the fifth wave or the Z wave? Well, first of all, 3 back, right? But then a final impulse, higher than Y, but look at the divergence. Very classic, guys, very classic. So, you know, you learn to read and recognize structure, and this is one. And I'm trying to share with you how to measure this structure and recognize it. And I tend to measure the smaller moves here, because it's far, far more accurate. It's actually deadly accurate, okay? So that's a typical Elliott channel, and that's a traditional count, if you will. And I'm showing you how a W forms and how divergence forms and how it breaks the channel and how predictable that is. Now, where are we with this count? Let me just take you in on a shorter term basis. Okay, where are we right now? Do you see the 3-wave move higher? Okay. By the way, measure it. Okay, here it is. It's an ABC, and I didn't hit that exactly correctly. Hold on a second. Let me do this right, because I want to show you something here on 3-wave moves that I think are important. A, B, and I didn't hit the low, did I? And this is the hard part of a webinar, guys. Trying to do this live is not easy. But hold on a second. I still didn't get it right. It's helpful to do this in the evening with a big glass of red wine, which is how I usually do this. Okay. All right. That's close to accurate. Now, 3-wave move, look where we hit, right to the 100% fib. Am I surprised? No. If I measured this right now, and I'm not going to because it would take me forever to do it, but here's a simple 3-wave move lower. Okay, the market tends to move in 3s. Okay, that's what I notice most of the time. Where are we right now? We're in the middle of a 3 back. Do you see the A? Do you see the B? Do you see the C down to the weekly pivot? By the way, I use pivots because price goes to magnets very often, and pivots are magnets. The purple line is the weekly pivot, right? What am I expecting from there? A move. And I'm expecting a move how long? Equal in length to this first 3-wave move. So let's just measure it real quick. Okay, so a little trick here on Apple. There's 615 ticks. What am I looking for from the weekly pivot? 600. What did I say, Jack? 613 ticks, right? Or 15 ticks, whatever. A little higher than this. So I'm looking for a move, and what am I looking for? I'm looking for the monthly pivot. Where is that? The blue line. Right? I have a box right here. Let's go back to the 60, because when you're on a 15-minute chart, how can you possibly see structure? I can't. Hold on, let me just size this and move it over. So you see what I'm looking for here is I'm looking for a 3-wave move up to the monthly pivot. What is that? That's called an inflection point. Why is that an inflection point? We have a 3-wave move higher, okay? And by the way, that's roughly speaking probably the 618 if I do the retracement stuff, right? And by the way, it pays to use retracements, right? Okay, where is that? That's close to the 618. It's through it a little bit, but this is a guiding principle, if you will, 50% back, 61.8% back. That's at the bottom of this trend line. It's at the monthly pivot. It's at a 3-wave move higher. What do you think is going to happen there? Well, to be honest, I have no frickin' clue what's going to happen there. I know that's going to be an inflection point and the market's going to make a choice. Do I know what's going to happen? I have no clue. I'm going to trade this appropriately, and when we get there, I may put on a short with a stop above if that's what I think is going to happen based on what I see on RSI and other things. But equally as well, this could go higher and we can make a new high. One or the other will happen. And a high into December, doesn't that make sense in terms of what might be happening in the market? Very well could be. So even though you can map out structure, even though you can use time-based analysis, even though you can count structure, use fibs, use floor ceilings, use pivots, guys, you got to respect the market. You don't know what's going to happen. I do not know what's going to happen, and when we get there, that's an inflection point. It's a 50-50. Anything can happen, and I'm going to have my antenna up and be paying attention to the market at that point. So that's the basics of a channel formation. Jack, let me throw it over to you so you can show a triangle formation. Okay, and are you ready?
Yep, ready.
Okay, throwing it over to you.
Right. Okay, I'm going to show a couple of triangles. I'm going to show you one that I know is an Elliott wave triangle. And this was one I did a few weeks ago. If you follow the free chart chats, you've probably seen this one talked about twice. But I drew this on 28th of August, and I drew in, this was an Elliott wave triangle which was breaking up. That's A, B, C, D, E. And it had just broken up, and we were here. No, must have been here. Yeah, we're here. And what I did was I was just using the characteristics of what you expect a triangle to do. First thing you do is you backtest back into the triangle. That was here. So I drew an arrow. The arrows are the ones in original blue here because I wasn't taking account of time, but I was taking account of price. So we were going to go backtest into the triangle. Then I was thinking that we would go and go to 1750. Sorry, it's slightly. I've been having some stock charts. Been updating the system. I've been having a couple of problems editing. But that's basically that line should be down there, and I was the rationale for hitting 1750 was there. And after that, that would be the end of the triangle thrust. And we'd come back and we would retrace the triangle thrust. So you've got backtest, thrust, full retracement of the thrust, and then I said at that stage we'd have formed most of an IHS, and we would go up, and if we made the target, TNX would reach, actually it's about 21.6, and it reached it a couple of days ago. Now, it looks like magic, but actually all I was doing was combining what we know about the way that triangles behave, because they tend to play out in a fairly predictable manner. The direction isn't always predictable, but the way it plays out is generally fairly predictable. So it actually filled all the boxes. It went up to there, very obvious target at 1750, came back, formed the right shoulder in this IHS, so you know, I was looking for a retrace into this area to reach that, almost made it, and it played out and made target a couple of days ago. And that was, I think, how large a move was that? That was at 1653, 35 on TNX, and it made target at about 21.6. That's a big move, and that was very much all predictable with the triangle. Here's another one from today. All right, this is on ZB this morning, pre-market chart, and I was talking about. Hang on, I'll show you the one I showed this morning. I was talking about a possible triangle here. And I was saying that what I'd expect it to do was come down to here, bounce a bit, but it didn't need to get back to this trend line, so wavy can be considerably shorter. And then assuming it was going to break down, then it would break down, it would backtest, and it would go. All right, let's fast forward. What happened during the day? Well, we broke down. I was asked on Twitter when we were about here, during the breakdown, what was happening on ZB, and I said, well, at this stage, what I would expect is fairly soon I would expect a backtest to the triangle, and then I would expect the thrust down to begin. And that thrust down should at least make this target here, which is 152 and 53, the current swing low. You retest of it. And what happened? Well, I think we were at 153.10 or something, and it reversed back up. This was just after the RTH close. Went back tested the triangle, and then a thrust down started. Triangles are great. Particularly when they've broken, because they have a very, very predictable way of playing out. And after this reaches, I'm not thinking it gets much further than this, and I'll show you one on the TNX chart, but this should be probably making the second low of a double bottom. We'll thrust down, we'll retest, probably go a little lower. It'll then retrace all the way back to here, and then I think it's going to take off and probably head back to 158. And the reason I think that is, look at this. This is a, I haven't marked it up on here yet, but this is a 60-minute RSI 14 cell signal, RSI 5 cell signal, nice looking double top. I was suggesting to somebody earlier today that we might well make this high because we already have a nice little double top on TNX, but the low on ZB was actually made in Globex. But we may well make the retest of the low in Globex as well. I think that's probably going to happen tonight. We'll probably find that we've rallied a bit tomorrow morning, and that the rally on the proper rally on ZB has then started from that point. So we'll see how that goes. But I mean, again, this is just using what you know about the characteristics of a triangle, where we are in the process. Are we looking for a reversal pattern, levels here? There's an A equals C calculation. I was using various little bits of TA from here and there, the RSI analysis and so on. But again, don't get too reliant on one method. But where you have something that tends to behave in a predictable manner, then you can use that. And I was using it on this TNX thing, and I was using it on ZB today. And you won't always be right, but you'll be right a lot. All right, those are my triangle examples, Tim.
Okay, very good. I have a question, and I'm going to use the question as, actually, I wanted to show one future as well, Jack, and I'm going to use the question to actually do that. So right. I was planning to talk about natural gas, but Sebastian, you've asked a question about cattle, live cattle. So I'm going to walk through live cattle, and by the way, everybody, Sebastian's question is, how do you know if the structure is made up of 3 impulsive waves or 5? I was looking to your daily chart of live cattle, and the structure is kind of the same as traditional Elliott wave, 5 impulsive waves. Okay, let's just talk this through a little bit. Okay, so first of all, commodities tend to move in 3 waves, not 5. Okay, and by the way, sometimes they do move in 5, and you have to be open to a 5-wave structure, and you have to be open to a 3-wave structure. So I'm going to take cattle from March all the way down to the Z. And I'm going to show you how I got faked out with cattle. But the way I traded it so I didn't lose any money, which is important. So, and the answer to the question, Sebastian, is this. It doesn't matter if it's a 3 or 5, okay? You have to trade it the right way so you don't lose money. Okay, so I'm going to show you that. So first of all, look at the first move down, the W in 3, right to the 100% fib. I mean, look at that. Right on the number, okay? That happens a lot, okay? It doesn't always happen. Typically what I tell people is this. When you're using 3-wave moves and you're starting out, look for a range. There's your range between the 100% fib and the 1.236. That's what you want to look for, okay? So first structure down is a 3-wave move, okay? Now, you got to have to, and by the way, those of you who are new to this are going to find this difficult. Here's an A, here's a B, a full retrace. Very often whenever I see a full back test or even a marginal lower low here, I'm seeing A, B, and I'm seeing a flat, a 5-wave move. We've talked about flats a moment ago. That is this type of flat, an A, B. B doesn't penetrate the origin, and you have a 5-wave move lower. Okay, so there's a flat. There's the flat. Where does it measure to? The 1.618. Did we hit it exactly? No. We were a little bit short, okay? And then what happens? We have this structure here. Now, what is this? This is a contracting structure that then leads to an expansion, okay? Now, the big structure is a 3-wave move. From X to Y is in 3, okay? I'm sure you can probably see it on the chart. I measure it like this. A, B, try to get it right here, and C, okay? Now, do you see it's between the 100% fib and the 1.236, okay? So you can't, the larger measurements are not as important as the smaller ones, okay? If you look, my bias here is not to use WX to look for the next level down, because fundamentally an X wave is nothing but a connector. It is just a connector. Each of these sequences are independent of each other. Okay, traditional Elliott wave, there's a relationship between 1 and 2, and we're supposed to go to the 1.618. It doesn't work in commodities. Okay, if I measure that, basically this is what I do. Okay, the A, the B. Look where the 1.618 is. It's way down here. Where's the 100% fib? Way up here. There's no relationship. Okay, and so traditional Elliott wave, there's a relationship between 1 and 2. 3 goes a specific length. In different situations that might be shorter or longer. Sometimes they extend, that sort of stuff, right? I use W and X because what I'm communicating to you guys with that is the X wave is a connector. Guess what? This is an independent structure from what happened prior to that. That's what X actually means, okay? So this is basically a 3-wave move, depending upon how you want to break it down. I would break it down this way. This is ABC. This is an X, and this is a separate ABC. And if you measure these independently, okay, like this and this, I'll try to do it real quick. You can see the 100% fib, right? It's just below the target there. Well, there's a 100% fib already measured for you, and you can see it comes in just above, right? So again, the back test, okay, and then the Y wave. Okay, now what did I say at this Y wave? I measured this because I was measuring this move and I was looking at wave 1 and I was looking at this as a target. Okay, I said this could be it. This could be the 18-month turn in cattle, right? What do we have here? A 3-wave move back. Do you see it? Okay, 3-wave move back. A, B, whoop, C, up to 100% fib. Did we hit the 100% fib perfectly? Well, pretty close. I mean, the high was what, 108.95. This is 109.60, so we were within what, 65 ticks? Not too bad, okay? Nothing's perfect in trading, okay? And what happened here? Well, I was wrong, okay? I was wrong. Now, I was long, and at the end of a 3-wave move, and this is how we trade on theartofchart.net. I'm just going to share this with you guys. I know you know this, Sebastian, but okay, so here we called the turn, and we said this could be the 18-month low. We could be going to a new high, okay? Where are we? We're 3 waves down, right? And I count in 3. So, of course, this could be a big transition. And I was looking at the 50% back area. As you can see, there's the box for it, right? And we hit that area. So our rule of thumb is basically last impulse. And let me just show this to you. Previous impulse, this previous impulse from here to here. When you're at the 50 back, you're off a third. And your stop is at even. Now, by the way, do you see the small 3-wave move right there? That would have been at the 100% fib. So right there, 50% back of the last impulse, we are off 1/3, okay? We have 2/3 of a position. With your stop at even, we are in a risk-free position at that point, okay? What do? Our stop's at even. From down here, we go up a third, another leg, right? Now we have a 3-wave move perfectly here, and we don't know if this is a W or an X. We don't know. Okay, what do? We take off a second third. We put our stop to even, and what happens? We're made wrong. Okay, we're made wrong. We came down, and we came even lower, down to this 100% fib here, and that's where we made the turn. Okay, and by the way, this is documented. It's on the website. It's on the weekly call. Okay, we made profit here on 2/3 of a position. We got stopped out. We got long again down here, guys. Okay, look at this. This is a 3-wave move to where? The 100% fib right up here at 110. So what I think is important to recognize here, and this is a long-winded way to answer your question, Sebastian, it is the smaller structure that matters, okay? It's a smaller structure that matters. I go to the daily chart, right? What is the relationship between W, X, and Y? There isn't one, okay? I'll tell you right now there isn't one. I haven't measured this, right? Okay? Where's the relationship? I don't see one. Okay, so commodities, and what you can do is you can make up a story and say, oh yeah, that's the 1.618, but you know that isn't even close. I mean, if we're within 60 ticks, okay, fine. We're a little short, that's okay. But for me, you know, I'm looking for something that is reliable, that works 70% of the time, that I can count on. Okay, and so you know that's how I do it. Now you have to recognize structure. So you know here's your initial sequence W. Here's your 3-wave move back. This you could see as a 3-wave move or a 5. Okay, either way. And you have to remember, everywhere where you see an X means the next sequence is an independent structure. 3 waves down here, 3 waves move back. You can see the 5-wave sequence here. This is a flat in A, B, 1, 2, 3, 4, 5. You know, and here's your 5-wave sequence down in a, and by the way, I was originally counting this, Sebastian, as a 3, right? And by the way I traded it again, it worked. I mean, I made profit on 2/3, but guess what? I was wrong. And it doesn't matter if you're right with the structure. What matters is that you can tell where the turn is going to happen. You put a position on. If it works, great. If you get stopped out, that's fine. You get to do it again, okay? And so far, you know, on this trade, we're doing quite well, 100% fib. By the way, at this point, where should you be? You should be out 2/3 with your stop at even, maybe even up here underneath the monthly pivot. We should back test not further than monthly pivot, and then the next shot higher should be a moonshot. I mean, I'm looking for X here to break at 124s sometime by the end of the year. We'll see if it happens. I don't know if it's going to happen, but so that's my answer. Long-winded answer to your question, and I hope you guys get how this works, okay, the 3-wave sequence. I think it's very important, and I think it's very useful. And by the way, I haven't really talked much about divergence, but look at the Y wave here, okay? Ys are typically your lowest level on RSI. Now look at this. Here's where the lowest level on RSI is. Let me just draw a line. Here's your divergence, right? okay? When you see that and you see a lower low like this, very close to a target, and by the way, draw your trend lines, right? Here we have a channel. You know, that's a low. That's easy to pick out, okay? And so you put some on and you set a reasonable stop and you see what happens. And so there's your divergence off of this structure. Was that the low? No. This was the low. Look at the divergence there, okay? There and also there. So could this have been the low? As a matter of fact, we said this could be it as well. Okay, so you don't know where the low is going to be, but you know this worked out perfectly. W touching Y, touching the larger degree Z. So you know, perfect touch here. I feel pretty good about this being the 18-month low on live cattle, and I think we're going to get a significant trend change here. That's my sense of the world, just based on counting it, okay, and also screwing up this long here, which I guess I hope what you learn about this is trading isn't about counting it right, guys. It's about trading it well. Okay, that's my main message there. So anyway, so with that said, we've covered so far on our agenda, and I know I've been long-winded, guys, but this is worth learning and worth explaining well. We've talked about what's different with non-traditional. We've talked about counts and structure. We've talked about measuring structure and using fibs to find inflection points. Okay, the only way you're gonna learn this. Boy, I'm really messed up here. Okay, the only way you're gonna learn this is by using it. Okay, and by following along. With Jack and I, you can follow along on the Twitter feed with us, or you can follow along if you're a subscriber, or of course you can follow along on the free post that I do on the blog post. But I think the way you learn something is by paper trading it, learning it, keeping a track record to find out, does it really work for you? And this may not work for you. Okay, I'm a bit of an integrator. I tend to pull many things together to make them work together. You may not be that. You may want something simpler. So, you know, it's up to you guys to figure out what works for you. Hopefully this helps you in terms of reading suggestions, story. What I would say to you is Prechter's book is a good introduction. Okay, as much as I don't have much respect for the man, I think that is a place to go to learn about traditional Elliott. It's a very easy read. Then for the three-wave move stuff,
good book.
Yeah, I think it was a good book too.
From a time before he sort of went badly off the rails as an analyst.
And by the way, I don't have respect for somebody who's just constantly calling the market short, no matter what structure is there. That's my hang-up with Robert. Okay, but. And he's been doing that since like 2011. He's been calling for a big bear market. So anyway, well,
the joke about Prechter is that he pulled 20 out of the last 2 crashes.
Yeah, so, right. Which book? Prechter has one book on Elliott Wave. His introductory book to Elliott Wave. I would go there first. Second, I would go to Ian Copsey. He's the guy who originated the three-wave move. His work is very complex, because he is a currency trader. So if you trade currencies, if you trade commodities, the three-wave move stuff, guys, it works, okay? And I think if you practice it, you'll find that it's valuable. And again, integrate it with fibs, integrate it with other things that you know how to do, especially patterns, okay? Because by itself, it'll get you in trouble, in my opinion. So, Jack, anything else you want to cover?
No, not on this. I've got some stuff to say on Fibonacci's.
Okay. You want me to throw it over to you?
Yeah, throw it over.
Okay.
I've got a couple of. I've selected a couple of very famous examples.
Okay.
Which just to illustrate the point, just because they're 2 of my favorites. Right, the first one this is basically just to illustrate a point on this, which is that this is a bull market here. This is you'll often get a bull market done in one pattern. This is 2. This is a rising wedge, and that breaks up in a rising megaphone. It's a 70% breakdown, that means 30% breakup. This particular 30% option broke up into a rising megaphone, and this, of course, is the very famous 1987 crash. Now, if you are having, you will generally speaking at the end of a bull market, you will do a Fibonacci retracement or a full reversal. In an equities bull market, because they tend to happen over long periods and you've got the effect of inflation, generally speaking, it's pretty much always going to be a Fibonacci retracement. So this is the bull market from 1980 to 1987, and then you've got this rising megaphone here. Any good patterns guy would have been identifying that this was an overthrow, bearish. You've got support down here, and of course it gaps through here. And of course everyone talks about, you know, is panic, blood in the streets, etc., all chaotic. It wasn't chaotic. Look where it retraced to. If you're on a continuation pattern, i.e. one that isn't going to fully reverse, what you're really looking for, the main targets are the 38.2, 50, and 61.8. What have you got? You've got an almost perfect 50% Fibonacci retracement. It was fast, very fast. You've got a lovely double bottom. You've got a breakdown for a pattern here. You've got a gap through, which is a very strong kind of a break, particularly so in this particular instance. This is actually a beautiful classical setup, which very much played out as you'd have expected to, just a lot faster. So don't let anyone tell you it was chaotic. It wasn't. To the trained eye, this was not at all chaotic. You were expecting the downside here. It just went a lot faster than you'd normally expect. Here's another one. Now this is something unusual for me. I very rarely show a log chart because normally I think they've got very little value.
Just one comment on that, Jack, real quick.
Yeah, go on.
Now you have to ask yourself the question, the 50 back area where support was found, was that because it was 50 back, or was that because there were lots of eyeballs looking at the 50 back area? So
could have been either.
Yeah, well,
could have been either.
Yeah.
But actually, that brings us to another point, which is that actually why people spend far too long on the why without looking at the what.
Well,
what can you reasonably expect to happen?
Yeah, I think that what works in the market for the most part, at least my pet theory, is where the most eyeballs are. So
sure.
You know, if there are a lot of eyeballs trying to figure out where support is, and the common conception is 50 back is a common area, well, guess what?
And those are the three most common fibs.
Yeah, right, exactly. So, exactly. Right.
And people do watch them. Yeah, does that have an impact? I'm sure it does. Certainly, and when you're looking at a move back to the 50 and then a retest and it finds some support there, are you going to get a whole load of technically minded people piling in along? Of course you are. You
bet money on that. I can bet money on that for sure.
Of course you are, absolutely. And you know, went up from there. So anyway, let's have a look. This is actually I've done this on a log chart because log charts generally fail the test, which is, do they hold a decent trend line? And generally speaking, the answer is no, but on some charts on long enough time frames, the answer is yes. This is the only way really to show this really well, which is the secular bull market between 1980 and 2000, is on a log chart, where it is a absolutely beautiful rising channel. It's what happens at the end of it? Well, you've got a back test, you've got a marginal new high, and you've got a breakdown. Now, technically, this could be a double top, but generally speaking, if it's got a target at minus 300, then you're probably thinking it probably isn't a double top. It's what does it do? It comes down and it stops. Where does it stop? I've got the 61.8% fib retracement of this secular bull market at 662, and the low is at 666. It's just beautiful. Lovely.
Yep.
And this is a wonderful Fibonacci retracement. This is the best way to look at it. And again, you know, everyone thinks it's chaotic, it's blood in the streets, everyone's going to die, you know, etc. And what you're looking at here is a secular bull market, and you're looking at a Fibonacci retracement in a secular bear market, and you're talking about, and then it goes. Classic patterns, classic Fibonacci rules.
Yep, absolutely.
So, and anyone who is watching the Fibonacci's on the secular bull market was watching those numbers. Yep. So, all right. So that is a very famous example. And again, it may look chaotic, but often you'll find it isn't.
Yep, makes sense. I want to ask one question before we end here. And well, first of all, if there are any other questions, please post them. But I have an interest to find out how many of you would have an interest in a more in-depth look at three-wave Elliott. And the reason I'm asking is I could do a series of these to a smaller audience that's interested in learning this, okay, which we might do like on Sundays or something like that, or not during market hours, of course. And the reason I'm offering this is I've had numerous people send me emails saying I want to learn more, blah 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 blah. But I'm just trying to gauge interest, okay? So If you have an interest, let me know or make a post right now. That would be something for me to see. And if there's enough interest, if I can get 10 or so folks, then I'll probably pull something together. Okay, so okay, so I have 3 folks so far saying yes, and I'll put this out on the Twitter feed tomorrow for those of you who are subscribers, and we'll take it from there. Okay, we're up to 5 already. So
we'll be up to Sunday. I'd actually be quite interested in coming myself.
Yep. Okay. Ken has a question, Jack. If you double down, then 50 back is out even? I'm not sure I understand that. Of course, regarding 50 back, if you double down, then 50 back is out even. Yeah. Now I understand what you're saying. That's true. That's true. Okay. I get what he's saying now. If from origin, yeah, right.
I think there's a couple of issues with doubling down. I mean, obviously we've done other webinars on this, but there's a couple of things you need to consider. Is if you only double down on your losing trades that aren't going as planned, then what you're doing is you're cherry picking your losing trades to be your biggest ones. And you've got to wonder whether or not that's really what you want to do. Because if you're cherry picking your worst trades to be your biggest, then you may well find that rather impacts on your P&L. And the other thing is you've got to have a really good reason to be doubling down, and it's not because you've already lost a shed load of money. Doubling down is an opportunity to lose even more money if it's still going to go down.
Yeah, right. You better have a really good technical reason for doing it. Like, for example, I'm off 2/3, right? And we're pulling back and we're at the 50% fib, and now I'm going to double down because I'm going to, after I've made a profit, I'm going to take that profit and I'm going to put it back in the market because I'm at a good technical area where I think we're going to get more upside or whatever, like we did with cattle, for example. So, that makes sense to me. Okay, if you're losing money and you want to double down, well, that is something to be cautious about.
Really is. Now, if you're adding to a runner on a trade that's already a success, then you're not adding to a loser, you're adding to a winner.
Yep, that's right.
Makes a lot of sense.
Okay. Story has a question. Jack, so looking at the top of the SPX chart, why do both of you and Stan say it's about to go up a good bit soon?
It's a variety of things. One of which is seasonality. 2, we've been consolidating and we've failed to break down. That should deliver at least a retest of the current highs, which we're watching at the moment, and then generally some continuation up. There is space. I mean, a year and a half ago, I was saying that really there was no more room after we got up to 2150. But the fact is, those targets are rising, and we've been hanging around here for a year. We can go higher.
Can you throw me the screen, Jack?
Yeah, sure. No worries.
Here's the way I want to answer the question, Story, and I want you to look at this based on you being a technical analyst, not a trader. Not a trader, okay? And by the way, I never, ever listen to somebody's opinion, okay? Because opinions, you want opinions? Listen to Twitter. There are 500,000, every single day, different opinions about the market.
That's right. If you want to talk to somebody who knows absolutely what's going to happen in the future, go to church. Don't look for it in technical analysis.
Yeah, right. So look at the structure. Here's 4. Here's a major turn in the market, right? Double bottom. And off we go. And I've been looking at this as a contracting formation, right? The A is longer. The A is the longest wave. The B to C is shorter. The last wave up should be the shortest. Okay. Now, do you think this is done? Okay, you might think it's done because our minimum target was 18,974. Could we break this lower trend line? Yeah, that's within the realm of possibility. But for me, these are all 3-wave moves. Okay, there's a three-wave moves here, 3-wave move here, 3-wave move here. There should be a 3-wave move to finish this thing. And by the way, do you see any divergence here yet? I don't see any divergence here. Okay, until I see some divergence here, I don't think this structure's cooked yet. Okay, so, that's my answer to your question. And what I would do is I would go to your chart and look at your chart and look at the structure and try to understand, okay, based on the structure, what do I see as possibilities? Use your own analysis, use your own intelligence, and so this structure tells me we're not done to the upside yet. Okay, I think we have a back test, higher prices coming. We have a divergence that we've yet to put in. So, you know, we need the back test. We have a bit of a back test here, a very, very small one, but we don't have any divergence yet. So, you know, and if we go to the S&P, we have that divergence already. We have the W. I think the W is fairly well formed here. So, you know, you have to, and by the way, that's good enough for a back test in my opinion, and then higher prices. So again, I think you have to be a chartist. You have to be someone who looks at the market technically and look at structurally what can happen here and what are the possibilities. So, you know, I hope that helps. Anyway, so I think that's a wrap, Jack. Anything else you want to cover?
I just want to say one other thing, which is that
please do.
Never pick a side.
Yeah.
You're not a bull conviction. I mean, if you want to support a team, you know, football, baseball, these are team sports. Trading, it's not a team sport.
It's about setups, guys. It's about finding good setups. That's it.
At the end of the day, if you really care whether the market's going to go up or down, then you care too much.
Yeah.
You should care about being on the right side of the trade. Whether it is up or down shouldn't matter. Feel that very strongly. And people want to define themselves in terms of teams, and this isn't a team sport.
Yep, that's for sure. Well said, Jack. Well said. I think no more questions. I think that's a wrap.
All right, cool.
Pleasure as always.
Pleasure's always, mate.
Yep, same here. Take care. Bye-bye.
Take care.